The international banking system is an enigma. Approximately 30,000 different banks exist around the world and they hold tremendous amounts of assets. As of September 30, 2021, the 15 largest banks alone had a combined total of $13.19 trillion in assets. It may seem complex today, but the idea behind banking was originally to make life simpler. Hello everyone and welcome back to the Finance Guardian channel. The funny thing about how banks work is that they function based on our trust. We entrust our money to banks to keep it safe for us, but then they turn around and lend it to someone else so they can make money for themselves. Banks are permitted to extend far more credit than they have in cash, yet many of us give the bank our complete trust that they can protect our money and give it back when we need it. How come we prefer to keep our money in a bank rather than under a mattress? Is it only because we receive interest on some of our accounts? Could it be that when we have cash in our pockets, we'll spend it? Or is it simply more convenient to use debit cards and write checks rather than carry cash? The answer may be any and all of these, particularly with electronic banking so convenient today. Now you don't even need to write that check manually. You can just swipe a debit card or click the pay button on the bank's website. In today's video, we'll explore the world of banking more and see how these institutions work. Hit that subscribe button and the bell beside it, and let's get started. Making loans allows banks to create money in the economy. The amount of money that banks are permitted to lend is directly impacted by the reserve requirements set by central banks such as the Bank of England in the UK and the Federal Reserve System in the United States. The U.S. Federal Reserve Bank requires all banks with more than $127.5 million on deposit to maintain a reserve of 10% of their total deposits. Banks can hold this amount in cash either in their own vaults or on their reserve account with the central bank. You can see how this affects the economy by thinking about it like this. Suppose a bank receives $100 as a deposit and has a 10% reserve requirement. It can then lend out $90. This $90 goes back into the economy, purchasing goods and services, and is usually deposited in another bank. Of that $90 deposit, that bank can then lend out $81, and that $81 again goes into the economy to purchase goods and services, which is then deposited in another bank, which proceeds to lend out a percentage of it. The result is that money grows and circulates throughout the community in an amount that is many times greater than what is physically existing. You may not realize it, but that initial $100 deposit has a much greater impact on the economy than you'd think. What led to this? Our system of banking originated with the goldsmiths, the predecessors of our current bankers. They noticed that people who deposited gold with them for safekeeping withdrew only small amounts at a time. The goldsmiths realized that they could lend out much of the gold left in their possession if they issued paper receipts on gold they didn't own. By charging interest, they made money on the loans. Loans were often secured by pawning silver plates or jewelry, and the receipts circulated as money. In no time, there were several receipts for one amount of gold, laying the foundations for a present-day fractional reserve banking system in which banks are able to lend out much greater amounts than they hold in assets. When a person receives a paper receipt for gold as payment for goods or services, the person can either save, spend, or trade it for the gold the goldsmith has in their possession. In the event of a run of two or more people who suddenly wanted their gold back, the goldsmith could usually rely on the fact that he had debtors who owed him gold, although they originally had nothing but a piece of paper. The payment had to be made in gold, and should they default, the goldsmith may sell their pawned items and buy gold to settle the claims. In what sense does it work? We depend on banks lending money to power our economy. Many jobs are created by bank loans to businesses. If we didn't have a bank mortgage, we would probably have to work our entire lives to accumulate enough cash to buy a family home. But banking is based on trust. When we go to the bank to get our money, we trust the bank to have it. We trust it to honor the checks we write to pay our bills. What is difficult to comprehend is the fact that people are putting money into the bank every day, while at the same time, the bank is lending the same money and more to other people. Banks continually loan far more money than they have on hand. It may seem a bit scary, but if you go to the bank and demand your money, you'll get it. The problem is that if everyone walks into the bank at the same time and demands their money, there won't be enough, prompting panic and what's called a run on the bank. The success of the banking industry is tied to the confidence of customers in the bank's ability to protect their funds. Due to banks' dependence on customer trust and the perception of integrity as a key aspect of that trust, the banking industry should always be heavily regulated by the government. Deregulation or relaxation of banking regulations have led to financial crises. A major issue with banks nowadays is that many of them have abandoned their traditional role as providers of long-term financial products in favor of short-term gains that carry much higher risks. During the financial boom, most major banks adopted financial constructs that were barely understandable and used their own trading methods to make fast money, as well as earning millions in bonuses for their executives and traders. It was nothing more than gambling that harmed entire economies and societies. Just as in 2008, when banks like the Lehman Brothers basically granted credit to anyone who wanted to buy a house, placing the bank in a highly dangerous risk position. This caused the housing market in the US and parts of Europe to collapse, causing the stock prices to plunge and eventually leading to one of the worst financial crises in history. Hundreds of billions of dollars were lost, and millions of people lost their jobs. The world's biggest banks paid billions in fines, and bankers became among the least trusted professionals. A huge bailout package had to be put together by the US government and the European Union to purchase bad assets and prevent the banks from going bankrupt. There were new rules introduced to govern the banking business, and banks were required to set up emergency funds to absorb shocks in case of another financial crisis. However, other tough provisions of new legislation were successfully blocked by the banking lobby. Other financing models are gaining traction today. A good example of this are new investment banks, which charge an annual fee and do not receive sales commissions, thus motivating them to act in the best interests of their clients, or credit unions established in the 19th century as a way of avoiding credit sharks. Simply put, they provide financial services in the same vein as banks, but with a focus on shared value rather than profit maximization. These models claim that their goal is to help members develop opportunities like starting small businesses, expanding farms, or building family homes while investing back into communities. Control is exercised by the members, who elect their board of directors in democratic elections. Credit union systems vary widely across the globe, ranging from organizations with just a few members to those with several billions of dollars and hundreds of thousands of members. Because credit unions are focused on delivering benefits to their members, they are less willing to take risks. This explains why credit unions, although hurt, fared better in the financial crisis than traditional banks. And let's not forget the explosion of crowdfunding in recent years. Besides making awesome video games possible, platforms developed that enabled people to get loans from large groups of small investors, circumventing the bank as a middleman. Nevertheless, it works for industry as well. Many new tech companies started out on Kickstarter or Indiegogo to gain recognition. It gives a funding individual the satisfaction of being part of something bigger and letting them invest in ideas they believe in. The risk is spread out so widely that if the project fails, the damage is limited. Last but not least, microcredits, loans of very small amounts, mostly given to developing countries in order to help people escape poverty, people who previously were not considered worthy of funding to start a business. Microcredit granting has evolved into a multi-billion-dollar industry in the present day. Although banking might not be your cup of tea, a bank's role of providing funds to people and businesses is crucial to society and must be done. Who will do it and how it will be handled in the future is up to us, though. And that is all the time that we have today, folks. We hope you enjoyed this video, and if you did, please remember to hit that like button. If you're new around here, subscribe to our channel, and on your way out, please do remember to click on that bell icon too, so you can remain updated about all of our future videos. You're welcome to the channel where you will learn the basics of personal finance in easy to understand language. We'll see you next time.